The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody, and welcome to today's webinar with CCIQ and BDO called Understanding Business Debt. My name's Colin Fruke. I'm the GM of Membership Engagement, and I'm your facilitator for today. Joining us today are two experts from BDO, Peter Winterflood and Marie Ryan. Peter Winterflood is the lead debt advisory partner at BDO in Brisbane. His debt advisory team is made up of former bankers who understand how banks operate and what bankers think. Earlier in his career, he spent more than 30 years in banking roles with Westpac, Commonwealth Bank and St George, culminating in 12 years as State Manager Queensland for Bankwest. Marie Ryan is a senior manager who has over 30 years finance experience across a broad range of finance roles, including residential, investment and business lending, private bank and corporate relationship management, credit, training facilitation and operations management. Today's webinar will guide you through the process of understanding business debt through identifying red flags, setting strategies, and identifying tips for managing relationships with banks and other financiers. We'd like to note that the risk grade context given in today's webinar is for business, not to be confused with personal credit scores. First, a little about BDO Debt Advisory. So BDO Debt Advisory have the finance networks, the knowledge and the experience to provide the advice you need to deal with all aspects of your financial arrangements, including improving the quality of your current banking relationship. Armed with the insight into your financial position, they work with clients to ensure the best possible financial outcomes. We do have a few polling questions available in today's webinar for you to answer. And if you'd like to ask Marie or Peter a question at any time during the webinar, you can do so using the chat box that appears in the bottom right-hand side of your screen. I'll now hand over to Marie and Peter to take you through today's presentation.
Well, thanks very much, Colin. Well, our webinar topic for today, as Colin said, is understanding business debt. So it's a broad topic and it's one of interest to any of us who are in the business of running a business, and that's a lot of us. In fact, at last ABS count, there are around 7.2 million actively trading businesses in Australia and 1.4 million of those in Queensland. So today we'll be talking about business debt in terms of what are the financial red flags exactly and how they can help you to have a better understanding of your business finances, what other types of red flags a business should be aware of. We'll also talk about some strategies and tips for managing your business debt and managing your all-important relationship with your bank. And as you know, there are many types of lenders in the market, as well as the traditional bank, but to keep it simple, we're going to refer to them generically as banks. So, to really understand business debt, you need to have an understanding of what goes on behind the scenes when banks are assessing your loan application. So there may be a time when your business loan was declined or your pricing seemed to be higher than expected, and there's a good chance that your risk grade may be the reason behind that. So before we get going, let's do a quick poll question to see how many of you know the risk grade for your business as calculated by your bank.
So we've just opened a poll that'll appear on your screen for a couple of seconds. Do you know your business's risk grade? Yes, no, or not sure. We'll keep this poll up for about 10 seconds.
Okay, we've got the results of that poll in. And not surprisingly, most people aren't aware of how banks assess their business. So the answer is no for most of you. So although all banks do risk grade business clients, it is rare for them to actually share those results with the business. There's some people in there that are not sure, and again, that's not too surprising, because it isn't a publicly advertised thing. But hopefully by the end of this session, you'll have a better idea about risk grades and what's behind them. So now I'm going to hand over to Peter, who's going to help to explain risk grades in a little more detail.
Thank you, Marie, and thank you, Colin. Just before we get into risk grades, I really wanted to talk about the comparison between serviceability and equity, and give you an insight into how banks think and how they approach it, and look, keep it at a fairly high level approach. What we've done here is done a comparison between the serviceability and the equity, and serviceability is extremely important measure that the banks look at when they're assessing someone's credit worthiness. And if you look in the top right-hand corner, box A, that's where you've got a situation of high level of equity and a strong level of serviceability as defined by ICR, or interest cover ratio. Look, a pass mark on interest cover ratio tends to be about 1.5 times, ideally probably north of 2. Equity, as opposed to LVR, which is more a measure of your security, banks look at a pass mark of being probably 50%, whereas LVR, depending upon the nature of the security, could be up to 80%, or sits generally for commercial lending around 70%. So if we look at the top right-hand quadrant, this is a situation where a bank would see you as having a strong level of serviceability and a strong equity position. Everyone wants to be here, clearly, but even in those situations, there are things that you can do with respect to your banking relationship. Look, as we go through this little bit of analysis, it probably is useful for everyone just to think about from their own business point of view, where do I sit? Which quadrant is it that I sit? Am I an A, B, C, or D? And from that, we'll give you some hints as to if you are sitting in that particular quadrant, what you should be aware of and what you can potentially do. So if you are in A, potentially you're in a strong position. You may well be able to negotiate better terms and conditions from your bank. If you find yourself in box B, so you've got a lower level of equity, but you've still got a strong serviceability, you've still got strong interest cover. This has happened to people over the years where the value of their security has declined, for example, and they find themselves all of a sudden with a lower level of equity. Nevertheless, business is still trading well, strong level of serviceability. So if you do find yourself in that quadrant, what you can do is by being diligent with the surplus cash, because you are very profitable, by applying that cash against your level of debt, you can find yourself moving back up into C by reducing your debt and improving your equity. Again, if you're in box C, you're in a situation where you've got potentially a high level of equity, but your serviceability is not meeting the grade. You've got a poor level of interest cover. Profitability is probably been challenged. Historically, you've probably been okay with a bank because you've had a really strong security position and the bank might have been inclined to continue to lend to you. However, without having that serviceability, you're in a difficult situation. So you need to be very, very mindful, because that strong equity position that you might still hold will be quickly eroded. And the worst case scenario, where you are in box D, you've got a low level of equity, you've got marginal servicing. And look, people find themselves here. You might be a startup, for example, and everyone's got to start somewhere, and not everyone is fortunate enough to start off with great equity and great profitability. So what do you do if you find yourself in this position? And the most important thing is to have a plan, is to have budgets, is to have projections, but to have a plan that you can present to your financier and talk about, if I'm starting here, how I'm going to work my way up into box B and then box A, or if I've found myself in here because of difficult times that I've experienced, whether that's through the equity has been eroded through valuations falling, or tough times in my business and my profitability, whatever the case may be, the most important thing is to have a plan to work your way out of that position. Okay, we'll now move on to a little bit more detail about risk grades. Now, as Marie intimated, risk grades are very important. They're used as a means of assessing your business risk by banks. They're used by all Australian banks. Very much something that was introduced post-GFC by APRA, an APRA requirement that all banks must use risk grade models. They're used for review. All clients with facilities $1 million and over are reviewed on an annual basis, and their risk grade reassessed. It can be a bit of a dark art. All banks, as I say, have risk grade models, but they're all very, very different in what they measure. Well, not so much what they measure, but the outputs. So, for example, different banks, you can have an 11 in one bank, an E1 or a D57, all across 3 different banks, but they all actually would measure the same level of creditworthiness. And if you're with the NAB, your scale is a 1 to 23. If you're with the ANZ, you're somewhere on a scale of 1 to 10. But if you're with a CBA, you're actually on a scale of A to H. So really, you can't read too much into those letters and numbers, other than to say that risk grades, they're not shared, so you'll never know those numbers anyway, but they are very important. And essentially what they do is they measure the probability of default. So that's why banks do this. So what they are measuring is how likely, when we look at all your information about your financial information and your industry and your business, how does that compare against other industries that are, or other businesses that are similar to you in your industry? And doing that analysis, how likely is it that you are going to default? So the less likely you are to considered to potentially default, the stronger your risk grade is, and the more the bank's likely to want to do your business. What the probability of default does for the bank actually determines that number determines how much capital the bank has to apply against your debt. So risk grades are, as we keep saying, absolutely important. What they do is, and it's an exercise that the banks do right up front, and it is pretty much the major determinant as to whether a bank will lend you money. You have got to have an acceptable risk grade. The NAB example, if you're on a scale of 1 to 22, if you came in at a risk grade of 20 as trying to be a new to bank, you would not, didn't matter how strong other things were, you would not be successful. The bank would not approve your new loans. So they determine whether or not the banks will lend. They determine the interest rates and the fees that then your particular risk rating can command, how long the bank is prepared to lend you the money, what sort of level of security, how significant and how far the bank needs to go with the security that it requires. Amortization, whether the bank's prepared to give you a period of interest only or whether it requires principal and interest payments from the outset. How often you need to report, whether it's monthly, quarterly or yearly. And also, very importantly, if your circumstances change and you go through some tough periods, how the bank's going to treat you under those situations. So what are the fundamentals of a risk grade? What are the things that the banks put into calculating your risk grade? So fairly obvious things that you would expect. What's your balance sheet look like? What's your equity like? And what loans do you have? How is your debt structured, short-term, long-term, which determines working capital? Do you have significant intangible assets sitting on your balance sheet? All those sort of things are factored in. The banks look at then your earnings. How stable are your earnings? The level of your profitability. What your earnings are before depreciation and amortization, and what's your capability to cover interest. And more, DSCR is a very important ratio that the banks focus on, and that is your debt service cover ratio. So it includes what it does is determines your capacity not only to cover your interest, but to meet all your debt requirements. The bank also looks at some of the external factors as well. What industry are you in? How much external regulation is there? Environmental risks that are associated with your business and with your industry. How volatile is it? Debtors and creditors. Do you have any concentrations? Do you have a significant part of your debtors that is just one business or a very few number of businesses? How well do you manage it? Do you have debtor insurance? A whole range of things around debtors and creditors are factored in. Also looking at some of those other external factors about exposure to world prices. What are you doing with your interest rate exposure management, your foreign exchange, if that's applicable, and what's your experience been with defaults? So they're all very much, I guess, quantitative measures, which everyone, no real surprises. What people don't always anticipate is there are also a lot of qualitative measures that the banks also assess, and your ability to produce management accounts regularly and on time, a really important thing. Are your accounts audited? What's your behaviours in terms of managing your excesses? Can you produce forecasts, and can you do it accurately and in a timely fashion? How detailed and how robust are the assumptions that you use? Are you able to clearly measure and articulate what are the drivers of your business and integrate all that information into a three-way forecast? Now, three-way forecast is a document that all bankers require pretty much for all business clients. It's a really one of the fundamental pieces of information that you should be providing, and that what banks are expecting. And just in the interest of clarity, what three-way means is it's a forecast that's done on the basis of balance sheet, profit and loss, and cash flow. So they're the three components of it. So historically, we've all done cash flow forecasts using an Excel spreadsheet. So this is just an extension of that, which reflects any changes that occur in the profit and loss or in the cash flow. They'll automatically be reflected in a change in the balance sheet. So if you haven't really embraced three-way forecasting, it's really something that you should talk to your accountant. BDO is very happy to assist with a preparation of those, but an absolutely essential document, particularly if you're looking at growing your business and acquiring more finance for acquisitions or whatever that might be. Look, some of the other things that the bank will look at too when they're assessing your business is how does it compare with other businesses. Again, it's something that you as business owners and operators, it's all very useful to be able to compare yourself to other like businesses to see how you rate. Banks also look at the type of debt you need. It's very important that you match the type of debt to what it is that you're doing, so that you've got adequate working capital. So that's either funded by an overdraft facility rather than term debt, or it's funded by a debtor invoice facility. So it's very important that you do look at matching the type of debt and the type of product that you require with the purpose for which you require it. Is your debt structure, are your facilities fit for purpose? And of course, banks also look at security. Look, as I mentioned up front, security is no longer the primary consideration for banks. It is, the second way out from a bank perspective. It's what the banks look for if everything else fails. So no one is in a position these days to be able to command additional debt just on the basis of the security. It must be supported by a strong financial position. But nevertheless, the banks will always require a level of security, which for businesses is the fundamental document is a GSA, previously known as fixed and floating charge. It's similar to that concept. So it's a charge over all non-landed assets or personal assets, and includes charges over stock and inventory and debtors. In appropriate situations, the bank will still look at real property mortgages. They will tend to look for directors' guarantees. Depending again on how strong your risk grade is, there may be some negotiation as to how much security to provide and whether there's a limitation on those directors' guarantees. In some instances, banks won't require directors' guarantees, but essentially they're the component, the basic components that banks look for in putting bank facilities in place. Okay, so that gives you an idea of how banks assess your creditworthiness, your applications. Let's just move on to, I guess, some of the things that you need to be aware of. So this is a situation where you've already got your facilities in place, you're back running your business, things are going along fine. These are the things that you need to be wary of should things start to fall off the rails a little bit. So these are the things that the banks will look for as triggers to start to ask some more questions and start to sort of be a little bit more intrusive into your business operations. And the big one that stands out is if you miss a loan repayment, if you miss an interest payment, or if you miss a principal repayment, the banks will very quickly focus on that and want to know what's going on. Also very interested in knowing what your ATO obligations are, and if you've entered into arrangements for meeting your ATO obligations, the banks are very keen to know about that. If you've already got one and they haven't been informed, quite often that will give them some cause to be concerned, albeit that quite often you may have been put into that arrangement by a very well-meaning accountant. Banks, again, are very concerned about that, and why they're concerned is it's another obligation, but it's also another creditor that may well put pressure on you that may present a risk to your business. Look, other things, if there's a maturity and you're unable to get the bank to roll over your loan, or you're unable to clear any any payments that's due, more reasons as to why the bank is going to start looking more closely at you. Overdraft excess is a significant one. You're unable to clear them within a short period of time or within terms of arrangements or to meet your promises, tend to be issues that the bank starts to look very closely at. Things that aren't as obvious, late provision of management accounts, your inability to produce a budget. If you're producing a budget that's on an Excel spreadsheet that's all hard-coded numbers with no ability to do any variations or any modelling, that also is probably more of a cross rather than a tick against your name. Sometimes too, just that lack of knowledge about a business. You're very involved in the day-to-day, but sometimes people can't see the wood for the trees and too close to the business and can't stand back and really see what is driving the business. What are those key profitability drivers, revenue drivers? What are they? Covenant breaches are another thing that you need to be mindful of. There have been times gone by where they haven't been considered such a big thing, but now you must, if you do breach a covenant or look like you're breaching a covenant, you do need to be on the front foot and be communicating with your bank about either the potential for it to happen or what you're going to do if it does happen to turn that around. If you're taking on new debts, and particularly if you haven't engaged the bank, particularly if you haven't let the bank know what's happening, are things that can give concern to the bank. If unfortunately you find yourself going down this path, banks, as most people would be aware, have different areas within them that manage debts once they have some form of concerns for the banks. So it may well be that all of a sudden your long-term relationship manager is no longer able to look after you, and you're being looked after by someone in another area of the bank. So that's a sign that things are being looked at very, very differently by your bank. Again, all banks have these areas. They're all called different names. Some people unkindly refer to them as a bad bank, but in they have names such as lending services or group account. Sorry, I'm just trying to think. The lending management, loans management units, asset management units, and the one that really does stand out is the strategic business services, which doesn't sound very much like an area that's the bad bank, but believe me, that's the area that looks after people who find themselves in difficult situations. Okay, so we're now going to run a quick little poll. I hand over to Colin.
So this poll is about your biggest challenge in dealing with your bank. Please select from one of the following options. Is your biggest challenge when dealing with your bank maintaining a satisfactory relationship with them, meeting the bank's terms and conditions, or knowing what information the bank needs? Keep that one open for 10 seconds. A few more seconds on the survey. And I'll just close the survey off now and share the results.
Okay, a little bit of a mixed outcome there. We've got the biggest challenge is knowing what information the bank needs. That's a standout, followed by concerns about maintaining a satisfactory relationship with our banks, and thirdly, meeting the bank's terms and conditions. But really there was a fair degree of spread across that, but I think knowing the information the bank needs does stand out, and I guess that resonates with what we hear with a lot of people, that it is very important. And what we do know too, that banks are quite often hamstrung in what they can and can't say to people, and that does create a difficulty. They are very conscious of not crossing the line when it comes to shadow directorships, and sometimes they are not as transparent. So again, I think the only way around that is to, if you're struggling to really understand that, is to seek some other help, either from peers or from professional services such as ourselves. Okay, look, just Marie I'll hand over to Marie in a little while just to go through some tips. But before we do that, just some of the things that you can just do in terms of looking at your business, putting it in a situation where banks are going to look upon it more favourably. But also, it's very important as we move forward with changes in what's happening in the financial platforms. Banks will continue to be a provider of debt, but you will see more and more alternative providers of debt, and we're seeing that every day. That whether it be super funds or whether it be private offices or whether it be private funds, there's going to be increasingly a different range of people who are potentially prepared to invest in your business, as banks have done historically. Now, what's really important for you to know or understand and take on board is you need to be investor ready. You need to position yourself such that if someone comes along and says, look, I've got some money in my pocket, I think you've got a good business, I would like to invest it. And when I say invest, I'm not talking about buying shares, I'm talking about lending you money. So something that you might have previously thought it's only the banks that will do that. Increasingly, there will be a whole range of other institutions that will be prepared to lend you money as you go forward, but only on the basis that you are actually ready for that. And that means having your act together, and doing a whole lot of things. And, we put this under the category of business hygiene. So cleaning up old entities, it's dealing with bad debts, it's, making sure that, you've got no obsolete stock. It's, after a rigorous process of stock taking, getting rid of assets, keeping liabilities in order, looking at your contracts, having plans and really giving that a level of comfort that you've got a whole range of risks covered when it comes to your business. I think also, if things aren't going well, and we talked about where that might lead, if things aren't going well, what can you do? It's probably a case of not putting, importantly, not putting your head in the sand. It's taking action as soon as you can, and that's not always easy. It's not easy to do it on your own, and hence why getting good advice is really the best way. And it's probably also a case of engaging other people and not keeping this to yourself. Importantly, it's also about bringing the bank in. A lot of people are very scared when they get into some form of financial trouble. They have a fear of telling the bank because they don't know what that's going to be, what that's going to mean, and whether the bank's then going to go off and appoint receivers and take all sorts of action. That will not happen. It's not happening at the moment. And if you're upfront and you're prepared to go to the bank and seek their assistance, you are going to be well received. And on the basis that, as I said from right at the beginning, on the basis that you have a plan. You have a plan as to what you're going to do to work with the bank to give the bank the confidence that you're able to work your way out. So a whole range of different things there that can be looked at just to shore up your business. And look, just to finish off some of those things, looking at your amortization, cash is king, a whole range of things that you can address just to improve your position. Look, I just really want to just focus on this three-way budget. I've talked about it. It's just really, just touch on it again briefly, just to emphasise how important it is. And if you took nothing away from today, just remember that is a really important document to work on it. I guess it fits in with what the poll says about provision of information, but it is a vital document that not only is really good for the bank and to give the bank confidence, however, it is also something that will be a valuable tool for your own business in terms of doing scenarios and doing modelling and just really being able to forecast where you're going and then to measure those results against that forecast. Okay, I would now like to hand over to Marie to talk about managing your bank relationships.
Thank you, Peter. Well, I'm going to cover some tips for managing your relationship with your bank. And firstly, you might need a loan or some other financial assistance, or it might be to grow your business or a temporary overdraft to cover you for a tight period. So number one tip, give plenty of notice. So whatever it is, always give your bank as much notice as you can. because relationship managers these days, they manage quite large portfolios of clients, and they have to juggle several requests at the same time. So couple that with, the general increased compliance and processes, and you can understand why deadlines aren't always met. So best to take all that into account and give them a heads up as soon as you know that you need the finance. And also, just do your homework before you turn up and see the bank manager. So make sure that before you see the bank, you think about the types of questions that they're likely to ask and have the answers ready to go. So questions like, the simple ones, how much you need and why you need it, the loan structure that's going to match your cash flow. So you wouldn't ask for an overdraft, say, which is expected to fluctuate over time if the purpose of your loan is to buy equipment and pay it down. Think about the term of the loan that makes sense. If you're going to ask for, say, a 7-year equipment finance loan to buy goods that have a 5-year lifespan, it might not make a lot of sense to the bank. Have a think about the interest rate, whether or not you need to consider interest rate risk management to reduce your risk. Your bank manager might need to arrange for the Treasury specialist to come along to the appointment as well. Think about the best borrowing entity and why. So that one might mean a chat with your accountant or your advisor about the different types of structures and the tax implications for those. And think about, of course, what security is available for the loan. So just come armed with the insight to these kinds of questions just to help with a successful outcome for your finance request. Also do your homework on your business yourself. So your industry, be comfortable. You can speak about your industry, the challenges and the quirks and the potential growth of the industry and where your business fits in. Your competition and your competitive advantage. So the bank manager may ask you, who your major competitors are or who the main players are in your industry. So understand the competitive advantage that you can bring. It could be pricing, quality, service, experience, location, whatever it is. Can you articulate what it is? Your key strengths and your weaknesses. So know your strengths and don't be afraid to talk about your weaknesses. It's not realistic that, you would have no weaknesses. So what the bank will want to know is that you've identified them and that you've got strategies to deal with those weaknesses. And their assistance might well be part of your plan. And finally, complete a business plan. So while it does take a while to do, so it can be painful, a written business plan is worthwhile because it forces you to think realistically about your business and it makes it easier to communicate your goals and your strategies to the bank. So the more comfortable the banker is that you have a clear business plan and you know exactly where your business is heading, the easier it will be for them to approve the loan. And as well as short-term planning, make sure you factor in the long-term planning as well. Relationships normally actually have to put together a fairly detailed written submission for your business loan approval. So if nothing else, they'll love you that you saved them time and they can cut and paste from your business plan. Okay, so what to bring along to that appointment? Well, the bank will need a heap of information from you to assess your loan. And it's not that they're saying they don't trust you, but they need to be confident that you can afford the debt and demonstrate what they did in their assessment. These are just the kinds of things that they'll ask you for, so best to have them ready to go. Up-to-date financials, so they'll generally look for 2 to 3 years, but they'll also want to see, that's historical, but they'll also want to see your year-to-date figures, so have them ready to go, which is pretty easy to do, just generating them out of your accounting package like Xero or MyOb. They won't expect you to be an accountant, but they'll expect you to talk to them about any anomalies, so have a look through them beforehand. If you can see anything unusual, large increases or decreases, just be ready with reasons why. Of course, the 3-year projections, as Peter talked, does show the full picture for the bank. And they'll want to see that your business is going to continue, of course, to be viable and that you've planned for the future. Business owners, of course, are often optimistic, but when you are completing those projections, it's best to be realistic, rather than to front up next year with your actuals a long way behind your projections. Yeah, just bear that in mind. The age debtor and creditor schedules, again, easy to generate from your accounting system, and they're going to be looking there at, debtors that are blowing out, or whether you have debtors insurance, that kind of thing. And the asset and liability statements of directors and guarantors. So most banks will want to know the strength of the people that are behind the business. And, they'll quite often ask for the guarantee of those directors as extra comfort. I've heard it argued, by one credit manager, but that if the director isn't comfortable enough to back this loan personally, then, why should the bank? So they'll generally want to see the strength of the people that are behind that business. And the tax office portal statements. So most banks will want to see that your tax commitments are up to date. So best to bring those along to the appointment with you. And again, your accountant can produce these for you very easily. As well as that, bring along a schedule of your current commitments, and this is just simply a list of commitments that generally lists the financier, the loan, limit, balance, rate, repayment, term. So the bank needs this to provide a full picture of what all your commitments are so that they can calculate your servicing. 12 months bank statements. If you're already with the bank, not necessary, but if you're a new client to the bank, really important to show the bank that over time, your contact is good, and hopefully there won't be any red flags on there like dishonour fees or default interest. Your organisational structure. So this is really helpful for a bank, particularly if you've got a complex structure. Again, there's plenty of online templates that'll help you to draw one up if you don't have one. And what they're generally looking for is how the entities are linked by ownership or by money flow, and who are the directors and shareholders of the various entities in your business. And finally, the business plan. Don't forget that to bring that along with you to show that you've got a good understanding of your business and its risks. Just a few don'ts here for when you're just in general managing your bank relationships. So don't be defensive, be confident about your business, but don't try to come across as defensive or arrogant, because you will be asked lots of questions by the bank, but they're really just trying to understand your business before they commit to the funds. Don't commit unless you can actually come through with what you're committing to. So this is all about building trust. Don't leave requests to the last moment, so best not to surprise the bank with a sudden need for their help. Show you're in charge of your business and plan ahead. Don't be vague on answers when you're answering questions about your business or your industry. They don't want to hear that you're not sure how viable your operations are or you don't know your competitive advantage. They'd like to be confident that you really know your stuff. Don't stretch the truth. Might be tempting to do this, but you'll only get caught out, as everything will be checked and verified, and the lender will lose faith in other truths that you've told them. Don't expect interest or fee reductions to help you to be viable. So banks are in the business at the end of the day of making a profit, and don't break promises that you've made to the bank. That's a really important one. And here's the do's. Do sell your business, not literally here, but your bank needs to really have a good understanding of your business and where it's headed. So whatever you do, you have to, sell your business to the bank. So explain your background, your purpose, where you're going. Do let your banker know what's happening in your industry. Do keep to arrangements. Behaviours such as regular excesses can have an adverse effect, so keep to those arrangements. Do remember risk grades now that you know the importance of them and what's behind them. Do be consistent with your communication in all dealings with the bank, and do understand the value of that bank relationship. So really get to know your relationship manager, their boss, and who the ultimate decision maker is. It is a really important relationship. And of course, the important one, do always communicate, communicate, communicate. So at the end of the day, open and honest communication with your bank is absolutely crucial. And finally, managing other relationships other than your bank. So you're not alone out there. Do stay informed about government assistance schemes which might benefit your business in times of needs. So there's different ones out there. The government have some, to boost specific industries such as agri. There's some for startups, so just be aware of them. Be a member of your industry professional body. That'll help you keep up to date with what's happening in your industry. Make sure that you subscribe to publications. CCIQ themselves are a great resource for businesses. Be involved in your local community. So this can be through sponsorship or volunteering, and this will all go to create goodwill for your business. And remember, you can't be expert at everything, so call on the experts to help you when you need it. So use your accountants and your financial advisors to help with your finances. Use lawyers, of course, to help with the legal side. And finally, don't forget your health. If your business is in trouble, the pressure can build to a point where it affects your health. But Don't be a statistic. You know, if you feel you're at that point, talk to someone. Talk to your friends or your local GP. And that is it from me. Colin, over to you.
Excellent. Thank you. Thanks, Peter and Marie. That was a very informative presentation. We've got a couple of questions. We're about to run out of time, but I might just shoot a couple of those at you quickly before we wrap up. Feel free to volunteer yourself to answer these questions. The first one is, where do I find comparative or benchmarking data on businesses that are similar to mine? I assume for the purposes of a loan.
Yeah, thanks, Colin. I guess it depends very much on the type of industry and how many competitors you have. And there's, I guess, peak industry bodies that invariably have that information. Colin, it might be something CCIQ could assist with certain industries as well. The ATO website is also can be quite a valuable source of that sort of data. Your accountant can quite often have that data as well. And it's important to combine those the benchmarks and look at the pertinent KPIs as well and measure yourself against those. So I think sound budgeting uses those benchmarks not only to see how you're going, but to measure your performance on an ongoing basis as well. So a variety of sources, not one source, but probably just a matter of asking the questions and doing some work.
Great. Second last question. Will a loan rejection affect my future chances from another lender?
Invariably it can, yes, depending upon the records that I guess are adjusted by that sort of application, how far it goes within the organisation. If it's a quick no by a relationship manager, unlikely to be any impact. However, if it goes through an extended credit process and there's a lot of inquiry as to the records, it can do. So I think what you've got to do is be very careful about that, not go out to a whole range of different lenders and get a lot of rejection. So the lesson is be better prepared so that you reduce your likelihood of actually having a rejection in the first place.
Thank you. And the last question that we have time for today, how do banks know or find out if I have outstanding ATO obligations?
Well, as Marie mentioned, providing copies of ATO portals, it's a standard requirement. So it's one of those things you should check it out first before you actually, go forward. And very easy for banks to find that out.
Okay, thanks. Look, we do have a number of other questions that we might get back to attendees on personally, but that's unfortunately all we have time for today. On behalf of CCIQ, I'd like to thank Marie and Peter for taking the time to present and giving our listeners advice on understanding business debt and financial red flags. I'd also like to thank everyone who joined us for today's session. So everyone who attended will receive a copy of the webinar recording and the presentation slides, which you'll receive tomorrow. I'll also include presenters' contact details in case you wanted to follow up with either Peter or Marie, and that email will also include a link to a credit risk assessment tool which BDO's developed to try and help you get a handle on your business risk rating before you move forward. Thanks for joining us again today. I look forward to welcoming you to another webinar in the very near future.